Thank you again for the opportunity to spend a few minutes with you, sharing our thoughts on the state of the market and the economy. And obviously, more importantly, we hope everyone's well and safe and healthy and navigating this very unusual period as well as could be expected. So if you could go up a slide to the cover, there we go. So it's a pretty straightforward presentation. It's mostly text. It's all text, actually. And the way we built it sort of a couple of weeks ago speaks to how fluid the situation has been. And what we wanted to do with the presentation was speak to where the world was just a couple, 3-4 months ago, because we think that has helped us better frame this very unusual market and economic cycle. And then more importantly, beyond where we are today, where we may be going in the back half of the year. So we're going to take a look back. We'll share some thoughts on where we are right now, and then we'll share some thoughts on what we think comes next. And to Caitlin's point, we'd be happy to try and answer any questions you may have or respond to any comments. So again, some of this is going to be dated, but we think context is important. So if you could just drop down one slide, Caitlin, please. So you go back 3 months ago, feels like a lifetime ago, 90 days ago, give or take, 120 days. And we put a great year in the books for the US market, right? We were up 30% plus on the S&P 500, which is the sort of bellwether benchmark for US equities. People are pretty optimistic coming into 2020. And a lot of good news, as they like to say in our business, was priced into the stock market. But we thought justifiably so. If you think back to last year, and I know it feels like, again, forever ago, but the one big overhang for the market and the economy was US-China trade, right? And we had solved for that with a phase 1 trade deal. And the economy, which is most likely in recession right now, was continuing a record economic expansion. But there wasn't a lot of excess, so you didn't see a lot of the silliness that you tend to get towards the end of an economic cycle. And most folks in our business, like or dislike the president, thought he would win re-election come November because the market was doing well, the economy was doing well. And again, like or dislike the fellow who sits in the Oval Office, most of his policies have been welcomed by Wall Street. The one outlier, again, was trade, and that had been taken off the front pages. So if you could go to the next slide, Caitlin. So as we moved into 2020, our worldview was you were going to see a pickup in global growth. Between the US and China, we're about 45% of world GDP. And with trade out of the way, you would see economic growth pick up, which means stock markets and asset classes outside our own would do well. And so you started to see that because most of the world badly lagged the US last year because of the uncertainty around trade. And here at home, Wall Street thought corporate profits would grow about 10% year on year. And even though we were at the time living through the longest bull market in our country's history, we'd argue that stocks were under-owned, meaning you didn't see the silliness that tends to present itself at the top of a bull market. So if you go back to the early 2000s, people thought stocks could only go one way and they were over-allocated to equities. If you go back to the start of this year, US investors had basically sold stocks for 10 years and missed the entire move off the 09 low. And so we were pretty optimistic on global growth and risk assets, and that played out with the stock market hitting an all-time high in mid-February when the S&P 500 traded at 3,400. So next slide, please. Thanks, Caitlin. And then COVID-19, or more specifically the coronavirus, was identified in China. That country took dramatic steps to mitigate the spread of the virus, which meant locking in a huge percentage of their economy. And despite China's efforts to contain the virus, it obviously quickly spread around the world. Italy, South Korea, other countries did the same thing China did, which was shut down a portion or all of their economy to try and mitigate the healthcare impact, the societal impact of the coronavirus. So China goes first, then South Korea, Italy, parts of Western Europe, in addition to Italy. And while the rest of the world was starting to slow, oil prices started to weaken as well because global growth was slowing. And as global growth was slowing, demand for the commodity was coming in. So OPEC sat down with Russia and said, let's cut production to support the price of oil. They failed to agree. And so they decided instead to pursue a production and price war. and the price of oil really started to roll over. And all of that was taking place outside of the US before we really had an idea of how serious COVID-19, or again, the coronavirus, is going to be. So the pressures were building outside our borders and then started to crest over and come into our country. Next slide, Caitlin, please. Thanks. So we began to get a sense of how serious the coronavirus was going to be. And even though our job is to think about the economy and the markets, this is obviously first and foremost a healthcare crisis and an economic crisis second. So obviously our thoughts go out to anyone who's been impacted directly or indirectly by this awful virus, and then COVID-19 after that. But as policymakers here at home began to recognize the seriousness of the coronavirus, they started to articulate the idea that, well, the only way we're going to kind of mitigate the impact of the virus and slow its spread is by shuttering in 70% of our economy, right? So our GDP is somewhere around $21 to $22 trillion a year, right? You're all business people. The Chamber of Commerce obviously is coming together for all these different business owners. And 70% of that GDP is what we do every day, right? The cups of coffee we buy, the cars that we rent, the restaurants that we frequent. And so as the market began to appreciate the fact that 70% of the US economy was not going to be able to participate in the economy the way it typically does, our stock market started to correct. And then beyond that, the oil price, which had been rolling over, both outside the US and then inside, we have two different benchmarks. Brent outside the US, West Texas inside the US, started to collapse, and our bond markets became stressed, meaning that markets just weren't functioning the way they were supposed to function. And then stocks really started to roll over. The S&P at one point off about 35% peak to trough, and we'll talk about that in greater detail. So as the financial pain and the economic pain started to follow on from the impact of trying to mitigate the coronavirus, Wall Street, Main Street, corporate America started to ask for help. And there are two policy levers in this country big enough that you can press on to try and mitigate something like the coronavirus, and that's fiscal policy, which is obviously the government's responsibility, and monetary policy, which is the Fed's responsibility. So the Fed took deliberate action. They took very swift action. They took unprecedented action. They cut rates to zero. So interest rates quickly went to zero. They launched a $700 billion bond buying program, and they injected trillions of dollars into short-term lending markets because markets were not functioning the way they're supposed to function. And while no one likes to see stocks and bonds move lower in value, I'd argue the only thing that's worse than that is when markets don't move at all, meaning when securities can't be bought or sold, and we were getting to that point. The Fed has since made that $700 billion purchase program open-ended. So it's open-ended quantitative easing, and not only can they buy treasuries and mortgage-backed securities, they can buy municipal bonds, and they can even buy high-yield bonds. So they've gone way beyond anything they did in 08 and 09 and anything they've done in the 100-plus year history of the central bank. It's unprecedented, and we're in uncharted territory from a monetary policy perspective. And it's not just the Fed. Central banks around the world have slashed rates to zero and are doing the same thing in terms of pushing liquidity into their markets. And then finally, fiscal policy started to act as well. The administration, the Democratic leadership recognized they were going to have to do something unprecedented, and they started to take action. So if you could go to the next slide, Caitlin, please. So where we are as opposed to where we were, right? So we have shuttered in 70% of our economy, give or take. The price of oil has absolutely collapsed, and I can talk to West Texas Intermediate trading negative last week if you're interested. And all of this is an unprecedented demand shock, deflationary shock to our economy. We've never lived through anything like this. It's not a credit crunch. It's not a housing bubble. It's essentially a collapsing of demand by government fiat at the federal level, state level, and local level. So as all that played out, the market corrected 35%. A bear market is defined as a correction of 20%. We got there in 20 trading days. It's the fastest bear market in our country's history. So most of us have lived through the longest economic expansion and the longest bull market in our country's history. We've now also lived through, unfortunately, the fastest bear market in our country's history. And a US recession is presumed. As we know, a recession is typically defined as 2 consecutive quarters of negative GDP growth. Q1 just came in at negative 5%. give or take. It's a preliminary number. It's going to be revised. It'll probably get worse. It's worse than people thought it was going to be. And that's even before we really felt the full brunt of the self-quarantining and the sheltering in place to try and mitigate the coronavirus. So we are all going to see, and we've begun to see, unprecedentedly bad economic news. And earnings this year for the S&P 500 will be off north of 50%. So there's a lot of bad news that is coming, that's already come. We've seen record highs in unemployment claims, millions of Americans filing for unemployment insurance. And we've seen record drop-offs in things like purchasing manager indices and consumer confidence. But there's a lot of good news too. Bond markets are clearing. What the Fed has done has helped dramatically in terms of liquidity. The stock market, while volatile, is well off its low. The S&P 500 is up about 34% off of what we think will prove to be the ultimate low for this cycle, and that was on March 23rd when it traded down to 2,192. We've got an unprecedented fiscal policy response in the CARES Act, $2.1 trillion. Nothing like that has ever been passed by our government before. And last week, the government topped off the CARES Act with $484 billion in additional capital. And the COVID-19 data has gotten better, including in states like New York and California that have been hit very hard. And then you may have seen the news out today, Gilead, which is a very large pharmaceutical company, a week and a half ago ran a very small trial on an existing antiviral drug of theirs called remdesivir, and it did very well treating COVID-19 patients, folks that were already very ill. The National Institute of Health just ran its own study, and those numbers look good. And we're starting to see that curve flatten independent of the pharmaceutical response here at home and obviously in other parts of the world. So that's the most important bit of good news, the healthcare news. Next slide, Caitlin, please. So what we're waiting for, again, some of this is dated because we've already gotten some of this. Good news on the COVID-19 front. Clearly, we're not out of the woods yet, but we expect good news on the testing front, and we're seeing a ramp up in capabilities there, and more importantly, on treatment and or vaccine. And again, the Gilead news out today is very encouraging. And then the impact of the fiscal rescue package. So $2.1 trillion in the CARES Act, $484 billion in incremental capital, two smaller packages passed prior to the CARES Act. The government's never done anything like this before. We think it's appropriate that they are responding the way they are, but now they have to get all that capital to the states and the companies and the people that need it most. And that's not going to be easy to do. There's going to be lots of mistakes made. It's going to be lumpy. So we're monitoring that. Two things to keep in mind. And we think we've already seen the second, which is the market will lead the real economy. So the market's up, knock on wood, 34% since March 23rd. It's still down about 9% year to date using the S&P as a proxy for risk assets or equities at a high level. But the market is a forward-looking mechanism. It will lead economic data. It will move higher while the data is still bad, and it will move lower while the data is still good. And then the coming economic downturn is going to be unprecedentedly bad, but it need not be prolonged. So the worst year-over-year drop we've ever seen in GDP quarter on a quarterly basis year-over-year is about 10% in 1958. What we see in Q2 is going to be far worse. The most Americans that had ever filed for unemployment insurance in 1 week, the record had been 695,000 in 1982. We saw that number hit north of 6 million 2 weeks ago. So we all need to be prepared for some really bad news. We've already gotten some, we're going to get more, but the basic thinking is behind, sorry, that's my dog Winston in the background. Winston! He's a great dog. Okay, so bear with me. The basic idea with what the federal government's doing, what the Fed is doing, is you've got this $21 trillion economy and 70% of it's just locked in, right? We're not going to restaurants, we're not getting on airplanes, we're not renting cars, we're not going out for dinner. So what the government has to do, and what the government's trying to do, in our opinion, is create a massive bridge loan that gets as much of the economy from here to there intact. And the idea is once you get to the other side of this from a healthcare crisis perspective, and we'll get there, if those businesses that are just closed right now for 60 or 90 days are still in business, and if their employees are still employed, they've just been sitting home for 60 or 90 days, well, knock on wood, when we can go back to being when we go back to whatever normal looks like, those companies can just open their doors and their people can go back to work. If those businesses don't just close, but they liquidate, and those entrepreneurs lose everything and they have to put those assets through bankruptcy, and their employees who have developed a certain skill set aren't just home for 60 or 90 days, but they're unemployed and they're out of the workforce, trying to bring those productive assets and those people back online is going to take a very long time. And it's going to mean that the rate of recovery is going to be slower, and it's going to take longer to build economic momentum, to say nothing of the societal consequences of millions of people and millions of businesses just going away, right? The emotional, the psychological, the societal, the healthcare consequences of that would be just awful. So the federal government, and we're the right to do this, working with the Federal Reserve, is trying to keep as much of those productive assets and people in place as possible. And again, there's only two entities in this country, in the world, big enough to create that kind of bridge loan. It's the Fed and the federal government. So things like the deficit and our ability to pay for this, things like moral hazard, we're going to reward some business people that were making bad decisions prior to this crisis. Our opinion is, with all due respect, that just goes out the window. You worry about that later. And that's what the government's trying to do. And obviously we're hopeful that they're successful. And if they are, once you get through this from a healthcare perspective, the economy can inflect much higher, much more quickly, as opposed to trying to fill in a hole that's going to be a lot deeper, would have been a lot deeper without help from Washington, D.C. So next slide, please, Caitlin. So where we are, one of the tools that we've built, our investment team, is something we call the Brinker Capital Bear Market Bottom Checklist. And the basic idea is the market's going to stop going down and inflect higher when the economic news is awful. So you can't really count on broad data to determine when the market has priced in the worst of whatever's going to come. But if you think history may not repeat, but at least rhymes, and you go back to our two prior bear markets, there are certain data points that present themselves when you're near or at a bottom, right? And they really don't have anything to do with the headlines, because again, that's going to be awful while risk assets are getting better. But things like investor sentiment, people are particularly pessimistic. Markets are very volatile. The correction has been about 30% plus, give or take. People are selling stocks indiscriminately, sort of they're moving away from the asset class, and you get a meaningful policy response. So, as we look back in history, in the 2002, 2003 bear market, the Great Recession bear market, if you looked at when the markets finally went sideways and then started to go up, all those 8 characteristics were present. And as we went through the worst of February and March, we started checking off more and more boxes. And we've checked off 7 of the 8. Credit spreads, meaning that the bond market was pricing in a tremendous amount of economic pain, never got as wide as they did in 08 or early 2000s. But we also think that's because of the unprecedented action taken by the Fed. So as we went through February into March and we saw these factors present themselves, we felt pretty comfortable making the call that March 23rd low was indeed the low for the S&P 500. And so what we've done is we've opportunistically added to risk where we have discretion over the portfolios, and we've positioned the portfolios to perform well in a more benign environment for risk assets. So again, history and time will tell if we are right, but we do think that March 23rd low will prove to be the low. There will be drawdowns, there will be volatility, but we think we've seen the worst of it from a pricing perspective, and we've positioned our portfolios accordingly. Next slide, please, Caitlin. What comes next? Another tool that the Asset Allocation Committee, the investment team, uses at Brinker Capital is our market barometer, where we look at short-term and intermediate-term and long-term economic factors. It's a classic stoplight metaphor. Green is good, yellow is neutral, red look out. Obviously a lot of red and yellow right now, which reflects just very challenging economic times and economic data that will get worse before it gets better. But the meaningful positives, right? Big picture, fiscal policy, monetary policy, those are meaningful positives right now because policymakers are all in, and investor sentiment is a contrarian indicator. So if you go back to the end of March, people were justifiably pretty bearish, which told us again that we were probably close to a bottom. And again, the economic data will lag risk assets. So we think as we go through the summer, we'll have a lot of red and a lot of yellow, but as we get into the fall, we'll start to see more green. Next slide, please, Caitlin. A couple slides that look at the market as a forward-looking indicator. So, you know, if you look at recessions going back to the early 1950s, when they started, when they ended, recessions tend to go for about a year or so. This one may be shorter just because it's self-induced, right? Again, it's happening because of government fiat. So if we can open the economy up, it can bounce back. The economy doesn't have to be in recession for a year or so. But what you see is that the market tends to bottom 4 months before the economy bottoms, and that the S&P tends to perform quite well from its respective low to the declared end of the recession. So again, the market right now is up about 35% off its lows. We're obviously going through a recession right now, but again, the way to think about the stock market is it's forward-looking. It will lead the economic data. If you wait for the news to be overwhelmingly positive, it doesn't mean that the market won't continue to move higher. The economy tends to expand more than it contracts, as you all know, you're business people, but you tend to miss some pretty parabolic moves, which tend to happen off the bottom when pessimism is at its highest levels. And again, we think we've seen that, and knock on wood, we've captured a lot of that. Next slide, please, Caitlin. Final data point. I think it's sort of interesting. If you look at what the S&P did up until mid-April, and it kind of has marked time a little bit since then. Now it's having a good week this week. Last 2 weeks were sort of sideways. That 13 trading day period for the S&P ending April 9th, and again, it's just a point in time, was the best 13 days in the history of the index, up about 25%. So if you look at the top half of the slide up on the screen right now, and you look at other 13-day runs where the S&P did particularly well, what you see is those runs tend to happen at bear market bottoms, right? 09, 08, that was a bit of a false signal in that the market didn't bottom until March, so you had a couple more months to go. But 74 was the end of an awful bear market, 82, the end of a double dip recession, and then the 2002 bear market. So again, you tend to see these big moves higher off the lows. Then the market kind of marks time for the next, call it 20 days, 60 days. But if you look out 125, 250 days, markets are almost always higher. So as we think about where we are right now, if we get some definitive news on the treatment or vaccination front, you know, our thinking will become even more bullish than it is right now. If it's still a bit of a muddle through, we think most likely the market is range bound for a bit because you've had this big move higher. But if you look out again 6 or 12 months, markets are almost always higher, and that's our expectation as well. Next slide, Caitlin, please. And then just a final slide that comes back to the idea of volatility and trying to time the market. And all we've done here is we went back in time and we took $10,000 and we invested it in the S&P 500 in 1999. And we said if we kept that $10,000 in the S&P through the end of 19, what would it have been worth? And that $10,000, because of the power of compounding and reinvested dividends and just a growing typical year-over-year increase in corporate profits, would have been worth over $37,000. And that's with the Great Recession and the bear market of the early 2000s. And then we said to ourselves, okay, you know, you live through stressful periods like what we're living through right now, and maybe you want to get out of the market, go to cash, and try and time this a little bit because it's just too stressful, which is completely understandable. Well, if you did that, and by doing that, you miss, say, the 10 best days over 20 years, or the 20 best days, or the 40 best days. So instead of having $37,380 at the end of 20 years, if you miss the 40 best trading days, which is 0.8%, right? So less than 1% of all trading days over 20 years, that $10,000, instead of being worth $37,000 and change, would be worth $4,441, right? So volatility is never fun. Down markets are never fun. Bear markets are never fun. But even with the unusual circumstances that we're all dealing with today, the unusual catalyst on the healthcare front that has triggered or been the cause of this economic and market crisis, history tells us a couple of things. Economies tend to expand more than they contract. Markets tend to go up much more than they go down. So as we all live through this very stressful period, and we think about our own portfolios or clients of ours, if we're in this industry, if you can, let your time horizon work for you, let the power of compounding and profit growth over time work for you, and try and put this current, very difficult, very unpleasant period in perspective. It may be different from any challenge we've faced before, but history tells you that there are always solutions to problems. And if you think about the amount of intellectual and financial capital being directed at the coronavirus and COVID-19, it's unprecedented. So we will figure this out. We will get through it. And in the meantime, because of the policy response, what would have been most likely a depression-like scenario is not going to play out. The downturn will not be as bad as it could have been because of what the government has done and is doing, and what the Federal Reserve has done and is doing. And then next slide, Caitlin, please. And finally, before I wrap up my prepared remarks, if you have any interest in receiving our market and economic commentary, also our behavioral finance commentary, we have a Chief Behavioral Officer, Dr. Daniel Crosby, creates great content. I would direct you to our Insights page. You can find it at blog.brinkercapital.com. If you enter your email address, you'll receive our weekly pieces on the market and the economy that my team produces, as well as our behavioral finance content. And again, I think it's just some fantastic material around the economy and the markets, and also how we can all navigate very stressful periods like the one we're in right now, and make better decisions through, again, very difficult and stressful periods like the one we're going through right now. So I will stop there. Caitlin and Marianne, if that's okay. Thank you again for your time, the opportunity to be with you all, and I'd be happy to try and answer any questions you may have.
Okay, so anyone that has any questions, you can raise your hand or write them in the chat box. Tim, that was really fabulous. Thank you very much.
Thank you.
No one has any questions?
I don't have any in the chat box. I'm trying to figure out how to stop sharing my screen.
Well, Tim, I think you did such a great job. I don't know.
I'll take it. I'll take it. Thanks.
There were, to me, it was just fascinating. It was really, when you talk about that much money and how much money that the government, what they're doing, and you know, at first it's scary, but you know, the way you explain it and what it has done, and you know, it's a really good thing, and we're you know, we're really very lucky that they're handling this.
I would agree. I would agree. Yeah. If anyone has any questions after the fact, you could always ping Steve, and Steve could forward them on to David or I via email as well. Yeah, no, but we really do appreciate the opportunity to be with you all today.
So we did just get one question. What businesses should do well in this new economy? Yeah.
So I'm a big believer in the idea that within the market and within the economy, strength begets strength. You know, there's always inflection points until it doesn't. So if you think about some of the trends before this, right? E-commerce at the expense of bricks and mortar, right? Remote and telecommuting and distance learning. So what this crisis has done, I think, is just sped up and added to a certain number of trends that were already in place. So I would think at a very high level, the strong are going to get stronger, right? The Amazons and the Apples and the Googles of the world. I think the education system is never going to be the same. Now, I'm not sure what that means from a stock perspective or an economic perspective, but I think commercial real estate is not going to be the same for a very long period of time. I would think that even if we go back to life as it was 4 months ago, meaning that we've got a vaccine, we've got a treatment, the coronavirus is assigned to the consigned to the dustbin of history, that most large companies are going to say, I want 25% of our people working remotely all the time. So I do think there's going to be massive disruption within commercial real estate, within the education space, and the trend around e-commerce is only going to continue. So near term, and things go one way until they don't. But if you were thinking about investing or sort of who's going to do well and who's not, I would just look at who's doing well right now and just assume that's going to continue, because we're not even to the other side of this yet. And then we'll have a better idea. But that's how I would think about this. And I do think commercial real estate and education, if I had to pick two parts of the economy that will never be the same, it's going to be those two.
And then just a follow up is, how should small commercial landlords repurpose their buildings for revenue?
Yeah, that's a tricky one. That's a tricky one. Yeah. It depends on the physical footprint, and my background's in economics and equities and not commercial real estate. But I would think people are going to want actually smaller spaces as opposed to bigger spaces. You're not going to want 10 people in a room. You're going to want 2 in a room. I would think. So it says 4,400 square feet. And I mean, it's just a tough question to answer right now, but I would think at a high level, and people are going to probably want greater flexibility around the space. How long are they going to lock in capital and leases? If they're sort of transitional, if it's transitional square footage, if I'm reading the question properly, that probably, I can't imagine that would change all that much then, if it's folks just kind of moving from their primary residence and it's sort of a transition. I would think that probably is going to be okay, but I do think commercial real estate is going to go through a very tough time. And then if you think about it, one of the overhangs on commercial real estate was just all the legacy retail space, set aside office space, because we never thought that was going to be impacted. So commercial real estate is trying to be repurposed. All those malls are trying to become life centers and sort of more experiential spaces, but that's just gotten hit with a huge hiccup as well. So it's going to be, I think it's just going to be tough. So I don't have much of an answer there, but I think that's a part of the economy that's going to have to reinvent itself. So. Sure.
Okay, anything else?
Hey, Marianne, it's Guy. Good morning.
Good morning.
I just wanted to thank Tim for doing this, and thanks for our staff putting this together. The last few weeks have been topsy-turvy for all of us, and we've tried, starting the last few weeks, to try and make sure that in the midst of sharing information on COVID and best practices and relief, that we started to get back to sharing the type of information and programming that we typically do. And we're very thankful for, I'm very thankful for our staff for making it happen. Appreciate all of our members taking the time, and folks like Tim taking time out of their busy lives right now, because all of us are multitasking. We're trying to work from home, take care of our business, and keep an eye on the economy, keep an eye on health. So I just want to say thanks for everybody making this happen and keeping us going forward and keeping us dialoguing about how to get through the next few weeks and months, and then to be prepared for what comes next. So thanks very much for making this happen.
Sure. Thank you all. Okay.
Thank you. Thank you.
Okay.
Thank you very much.
So we have recorded this, and we will make it available to our members and well, we'll make it available to everyone, really. But Tim and David, thank you so much. Steve McGinn, thank you for bringing us Tim yet again. It was wonderful and insightful, and actually a little bit optimistic, so that was nice. Thank you for that.
Sure.
And to everybody on the phone, thank you so much. I know that you have lots and lots of options out there, so thank you for coming with us and joining us this morning, and look forward to some more of these. Thank you so much, everyone.